year, but declined 3.5% sequentially in constant currency. These declines were mainly due to ramp downs in manufacturing and the medtech vertical. Our software business had a good 3.5% year-on-year growth in constant currency. On the people metrics, our headcount at the end of the quarter was 219,401, a reduction of 3.6% from a quarter-on-quarter perspective. But a very large part of this reduction is attributed to the State Street joint venture exit that we had announced earlier in the quarter. On an LTM basis, that is last 12-month basis, our IT services voluntary attrition stands at 12.8%, amongst the lowest in the industry. Coming to the geographies and the verticals, geographies on a year-on-year basis, Americas grew 8%, Europe grew 3%, and the rest of the world business declined at 3.6% in constant currency. In our verticals, on a year-on-year basis, telecom and media and retail and CPG fared well, growing at 69.2% and 9.7% respectively. Manufacturing grew 3.5% year-on-year in constant currency, and it declined on a sequential basis. Life sciences and healthcare declined 4.1% year-on-year in constant currency, primarily because of completion of projects that happened last year, and also some softness that we saw in the medtech industry segment. Within Gen AI space, we continue to witness a lot of traction on AI and Gen AI related opportunities. After launching HCL Tech AI Force, a generative AI and automation platform a couple of months ago, we've launched another offering called HCL Tech Enterprise AI Foundry to simplify and scale enterprise AI journeys. We have multiple ongoing engagements where we are working with clients to deliver real value, like for a global technology major who selected us to implement a Gen AI-based solution for gaming review analysis, including the automation of data collection, sentiment analysis, and the operational automation, resulting in significant workload reduction. They also selected us to deploy Gen AI to transform their content lifecycle management and the processes. During the last quarter, HCL Tech has been ranked in the Business World's India's Most Respected Companies 2024 list at number 7. We're very happy to note that, and we're happy to announce that today. And we were also named as the most honored company in India in the annual Asia Executive Teams Survey by the Institutional Investor Research. HCL Tech ranked number 1 in 21 categories in the technology, IT services, and software sector, and had a total of 27 top 3 rankings across Asia ex-Japan and rest of Asia ex-mainland China survey tracks. I would like to thank all the investment analysts and investors for their acknowledgement of our good work. Now, looking ahead with Q1 performance in line with our expectations, we expect to grow in Q2 with all verticals and geographies seeing a sequential growth except financial services. As you know, we shall have the planned impact of State Street divestiture on our revenue in Q2, and including that impact, we remain comfortable with our full year revenue and margin guidance as clients spend on Gen AI and other emerging technologies are seeing some traction. We expect to meet the guidance through strong operational execution that we've demonstrated over the last several years. With that, I will hand over to Pratik to provide more details on our financials.
Thank you, CVK. So CVK has given you the constant currency growths. I'll just touch upon the rupee growths on a year-on-year basis as well. And in there, the HCL Tech revenue came in at 28,057 crores, which was 6.7% year-on-year growth. And within that, services stood at 25,360 crores, which is up 6.9% year-on-year in rupee terms. ITBS grew at 6.4% year-on-year in rupee terms, and ERS was up 9.5%. HCL Software was up 4.3%, again in rupee terms. EBITDA margin came in at 5,793 crores at 20.6% of the revenue, which was a growth of 7.5% year-on-year, again in rupee terms. And EBIT margin came in at 17.1%, 4,795 crores, which is an increase of 13 basis points year-on-year, and increase of 7.5% year-on-year as well, just like the EBITDA. Net income came in at 4,257 crores, which is at 15.2% of the revenue, which is up by 173 basis points, 1.73% year-on-year, and increase of 20.4% on a year-on-year basis in rupee terms. Our focus on profitability and managing capital efficiency continues to deliver notable improvement in return on invested capital. That's the extra page that we put in every quarter, which I hope you do look at it as investors and analysts and media. And that continues to grow. The last 12-month ROIC stands now at 34.6% at a company level, which is an increase of 3.5 percentage points on a year-on-year basis. And on a services basis, that is now at 42.8%, which is an increase of 4.8% year-on-year. And software continues to be at 16.1%, so it's flat on the last couple of quarters. We continue to demonstrate healthy cash conversion. Free cash flow came in at 21,637 crores, which is an increase of 14% year-on-year for the last 12-month period. This also represents a conversion ratio of 133% of the net income. So let's say if you have profit after tax of 100 rupees or $100 million or whatever, the cash conversion is actually 33% more than that. And our balance sheet continues to remain very strong. Gross cash of 27,000 plus crores and net cash of close to 25,000 crores. We brought down the DSO by another day this quarter, including unbilled of 82 days, and decrease of improvement of 6 days on a year-on-year basis. For the shareholders, therefore, the last 12-month diluted EPS comes in at 60.52. That's the EPS, and that's an increase of 8.7% year-on-year. And the board has declared a dividend of rupees 12 for the quarter, the record date of which is 23rd July. And the payment of the same shall be on 1st of August 2024. With that 12 rupees, the last 12-month payout comes out to be 54 rupees per share, which is a payout ratio of about 89% of the net income. Little higher than the typical payout rate that we've had in the last 2-3 years. With that, I'll hand over to Ram, our CHRO.
Thank you, Pratik. Good evening, everybody. I think CVK has already given the headline message about where we are with our headcount and our attrition. Headcount this quarter, we need to look at the headcount, taking into account the effect of divestiture that happened, State Street. Outside of that, if you see, it's quarter-on-quarter effectively flat. That's in line with what we had planned for, given the investments we had made in the previous quarters in preparation for the offshore transitions planned for a couple of large engagements. So headcount is in line with what we had planned for. During the quarter, we added about 1,078, 1,100 odd freshers. That again is in line with plan for Q1. Attrition at 12.78 LTM, IT services continues to be at the lower thresholds that we have had in many quarters now. So that continues to be a positive story. We expect it to sort of stabilize around similar levels so far as attrition is concerned. So those are positive stories. I think the biggest thing is around the traction that we are seeing in Gen AI. Last quarter, we sort of reported the investments we are making in upskilling our people for Gen AI skills. If you recall, last year we trained and certified about 42,000 employees. Our plan this year is to be able to continue that momentum, which typically means that every quarter we need to add incrementally about 20,000 people trained and certified, so that at the end of the year we'll cross the 100,000 mark. So we're on course to do that. Q1 we have worked through the plan, we have achieved what we had planned for. So our focus on upskilling continues, both in terms of what we do for Gen AI as well as broader data and analytics skills as well. So our focus continues on that. So that's in terms of readiness for growth in Q2 and beyond. So that's a brief. I'll just pause here. I will open the floor for questions.
So anybody, you can raise your hands and I'll pass on the mic to you.
Hi, gentlemen. Shavik Das from Mint. CVK, we want to start with understanding a little more on the slowdown that you're seeing in manufacturing. It's generally been a sort of resilient sector. So a little more color on that. And as well as on generative AI, do you have a number for the kind of revenue you're seeing from these projects right now? And yeah, I think just on that and we'll follow.
First of all, manufacturing, as I mentioned in my opening remarks, of course, there were, normally this quarter, we have a certain seasonality. Like in April, a lot of productivity benefits kicks in, and manufacturing being a pretty large vertical for us. So there are a number of clients in that category where the new contract year starts on 1st of April and certain productivity benefits we have to give. And that was already factored in the overall guidance that we gave. So in addition to that, we saw some weakness in the automotive segment, which we did not expect. That further contributed to the overall weakness in this segment. On generative AI, at this point, we are doing a lot of POCs. We are not ready to call out any bookings or revenue numbers. When we are ready, we'll let you know.
Right. Just an overall commentary on the rest of the market and how you expect FY25. Do you see stronger sort of recovery on the horizon?
Yeah. So at this point, as I mentioned during our full year results last year, we've not factored in any significant pickup in the discretionary spend. Our assumption has been the discretionary spend in this year will be the same as last year. And we continue to maintain that, though we see some actions which show that things could have bottomed out, but I still do not want to kind of take a call that things have really bottomed out, because there has been so many false starts in the last maybe few quarters on where the recovery will happen and things like that. So we stay with our full year guidance of 3 to 5% growth in constant currency. And the first quarter we have done a little better than what we had anticipated. And second quarter we are confident of a positive growth in spite of the revenue from the State Street divestment going away, we will grow, and we will grow in all geographies and verticals except financial services. That's the outlook for the Q2.
Just one follow-up. Do you expect the margin to kind of remain around the 17% range?
Our annual guidance on the margin is 18 to 19%. If you see the trajectory that HCL Tech has taken, usually Q1 is the lowest, Q2 we pick up, Q3 we peak, and Q4 it goes down a little bit. We expect to see a similar trend on margins like we saw in the last year, this year as well.
So you'd be meeting the guidance
That's right.
Just one last, Ram. Just in terms of hiring, how do you expect fresher hiring to play out this year?
So we planned for 10,000 hires this year. Freshers, it's always going to be a case of moderating our plans quarter on quarter. That's one of the reasons we plan campus and off campus as well. So we build reasonable flexibility that we need to be able to respond to the needs as we look at demand a quarter ahead. So that plan continues. So we continue to keep our campus plan we have executed, and whatever is residual, we are executing that. Our off-campus plan will always be to address the moderation that we need to do each quarter. So that continues.
Hi, Annapurna Roy from the Economic Times. Could you speak on why EBIT is down while net income is going up? And also, what are your expectations regarding BFSI in the America market, the recovery there?
Yeah, there is other income which is higher, as you can see. Just compare quarter on quarter, it's about 70 million higher. That's because of the State Street divestment that we talked about already. So that's the number really making the difference.
Yeah, in terms of financial services, if you've seen our past results, last year we delivered a very strong growth in financial services, 11.5% constant currency growth, and which was really enabled by the large deals that we had won, as well as some of the discretionary work that we continue to do for our clients. And some of these deals have transitioned into from an onshore model to a global delivery model, which means the revenue would come down, and that's what you're seeing in this quarter. And moving forward, we continue to see a lot of cost optimization deals, and we continue to see modernization and technology transformation kind of opportunities which will result in significant efficiencies for our customers. So that's what we are seeing in the pipeline. There are a couple of transformation projects as well. So we expect, of course, in Q2 will be a declining quarter for financial services because of the State Street divestiture revenue going out. But after that, we would expect to see growth in this vertical.
Anyone else?
Hello. Hi, this is Ashutosh from Business Standard. Just a couple of questions for Ram. Other than State Street, any other reasons for headcount fall? And out of the 10,000 fresher hiring target, what's the plan for going on campus for this?
So first part, if you look at the headcount after adjusting for the divestiture, the headcount is pretty much flat. I think it's about 680 or something is the delta between Q4 of last fiscal to Q1 this fiscal. So that's pretty much flat. And that was in line with what we had planned for. There were a couple of large engagements where we were planning for offshore transitions. So we need to build capacity for that. If you go back and look at the Q3 and Q4 of last fiscal, we had both quarters, we had positive additions. I think if I look at Q3, Q4 of last year, it's about 6,000 plus net addition that we have done in those 2 quarters. That was done in preparation for the transitions that we need to do. So obviously we don't need to add more capacity this quarter. So that's a way to look at the number in the context of what has happened. Fresher, as I said, it's we're always going with an annual plan, but the execution of the annual plan is going to be a combination of what we do through our campus program and what we do through off-campus program, and that's become a requirement for us to be agile, because campus happens seasonally, right? It's a once-a-year event that you do if you have to go on campus to do it. So it's always going to be a mix of what we do on campus and what we do off campus. On campus, our plans are executed to what we had planned for this year. So we've done our visits, we've made our offers, so that will flow through the year. Off campus will always moderate it to 1 quarter ahead of what we need. So that plan will continue. We will expect to moderate the numbers as we see a growth quarter on quarter.
Any more questions? No. So we'll take questions from people who've joined us virtually. Siddharth, over to you.
Thank you, Ashutosh. Ladies and gentlemen, in case you are on your computer system and want to ask a question, please click on the raise hand icon on the bottom right of the participant panel and we will unmute your line. In case you have joined on audio only, please press *3 to raise your hand. And if you experience any technical difficulties, you can message your question using our chat box. Our first question is from Ms. Anisha E.T. now. CVK, she has written in the chat box, Dealwin is muted. Is this because of delay in decision making? How is the pipeline? One. The other question is, when do you expect BFS to recover? Any signs to point to an improvement? Is weakness in manufacturing expected in Q2 as well?
Yeah. So Anisha, thank you for your question. As I indicated, in Q2, we expect to grow in all geographies and all verticals except financial services. So which means even in manufacturing, we expect to recover in Q2. Financial services, as I mentioned, there is cost takeout opportunities, and Q2 will be a soft quarter for financial services, but after that, we are confident of sequential growth in financial services. Coming to your first question on deal wins, $2 billion roughly is our run rate. And just want to highlight that this $2 billion is net new wins. This is new wins from existing customers and new customers. So this is really there's zero renewal or rate card in this. It's purely a new business. So from that perspective, it's a good booking. We expected a little bit more. A couple of programs, the decision got delayed to this quarter. So that's how we came in at $1.96 billion. We expect to see good bookings moving forward.
Thank you, CVK. The other question is for Prateek and Ram. Prateek, on the margins and revenue, what's the impact of State Street divestment in Q1, and will there be a further impact in Q2? And for Ram, there is, when will you announce wage hikes this year, and will hikes be around last year levels, better or weaker?
Yeah, so as far as the State Street transaction is concerned, I think we mentioned that in the previous quarter as well. There is an impact of about 80 basis points at a company level, and if you translate the same at a services level, it is about 90 bips, which is what we will see in the Q2. And that's the thing that CVK already addressed up front, that we expect to see a growth in Q2 despite that impact.
So I think the question was on wage hikes and what the plan is. It's usually the jazz quarter that we make our decisions on wage hikes. So there's proposals that we are working on. It's a decision that is to be made. That's the current status. But the more important thing is we need to look at wage hikes in the context of where we are with reference to compensation and how do we benchmark ourselves. Since FY22, when we were going through the growth cycle, our mix of intake has been more experienced professionals as compared to entry-level professionals. So that mix is going to play out as we look at 23, 24, and 25, that continued, that mix shift continued. So if you look at the current compensation levels that we have amongst our employees and do a benchmarking exercise, we are pretty competitive. So that's going to influence our decision, and hence we right now are working through the details of what the decision will be, which we'll make during the course of this quarter.
Thank you, Ram. Our next question is from Rukmani Rao from Fortune India. Rukmani, please go ahead.
Hey, hi. Thanks for taking the question. I hope you can hear me.
Yes.
Sure. Thank you. CVK, my question was with respect to the CTG acquisition that happened some time ago. Since you've not really disclosed the revenues of those assets, right? Want to understand from you, what does this bring to HCL Tech, and what do you expect out of this acquisition?
Yeah. Rukmani, thank you for the question. This is a set of professional services for communication service providers is the real business that we are acquiring. This is an opportunity that we are carving out of HP Enterprises, their communications technologies division. We called out the investments that we are proposing to make, which is $225 million. The revenues we will call out as and when we consummate the acquisition and we record the revenue in our books. Because this is not a standalone entity, it's a carve-out from another large company. So that's the reason we have not disclosed the revenue of this business. In terms of what it gives us access to about 15 of the top 30 communication service providers in the world, where we will have significant revenues in each of these clients, which really helps us to cross-sell and upsell other HCL services to all the communication service providers, clients that we acquire, as well as help us position the acquired groups, professional services work to some of our large telecom clients in North America. So it's really a expansion of our engineering services in the communication service provider segment with access to a number of top telecom service providers as our clients. Yeah, largely in Europe and Japan.
And just to add, for the sake of good order, the guidance that we've given is without considering any revenue from this. There is, we expect the deal to close within 6 to 9 months of the announcement date. So as and when we add that will be over and above.
CVK, so this will be showing up in your ER&D segment revenues, is it?
That is right.
So, CVK, the other thing that I wanted to know from you was, with Gen AI, how important is collaboration with hyperscalers going to be, and how is that taking shape? If you can give some understanding of how services companies and hyperscalers are collaborating, and at what points and what junctures is the Gen AI integration towards that. Thank you.
Yeah, I think that's a great question. This is very similar to how the public cloud adoption and how the ecosystem partnerships really played out in service providers like us taking the hyperscaler solutions to the market. It's a very similar journey. However, here there are two paths. One is hyperscaler-led solutions, Gen AI and the large language models and all the solutions that hyperscalers bring to us to take it to our clients. But there is also a significant opportunity in private AI stack, which a number of enterprises are exploring, and some of them have already implemented. This is again a big opportunity. We've launched an offering called Cognitive Infrastructure Services, which is all about getting an NVIDIA stack or NVIDIA embedded Dell or a HPE stack and building a Gen AI infrastructure for our clients on-premise or in their hosted data centers to really deliver a private AI stack and build all their GenAI application and use cases on top of that. So both models are prevalent in the GenAI journey of enterprise clients. So we have strong partnerships with Microsoft, Google, and AWS. We've already announced two very significant products, HCLTech AI Force and HCLTech AI Enterprise Foundry, which really helps in the setting up an enterprise AI stack and the data requirements to drive all the use cases within an enterprise. And the HCLTech AI Force is an end-to-end lifecycle management for software development, which leverages any large language model. We've already integrated Microsoft, we've already integrated Google, we're in the process of doing this for AWS. So it's a very highly collaborative and cohesive operating model with our hyperscalers.
Thank you, CVK. Our next question is from Devangana from Money Control. Devangana, please go ahead.
Hi, CVK. Am I audible?
Yes, please.
Yeah. So my first question to you is, we are seeing telecommunication, media and entertainment vertical has grown by, I think, more than 69% in constant currency terms year on year.
Yeah.
So I wanted to understand how much of this growth is coming from the Verizon deal, and also do you expect this kind of momentum to continue going forward from the telecom media segment, because overall from an industry perspective telecom has been a bit subdued. The second question is, in this quarter we have seen a lot of semiconductor and chip designing deals coming for HCL Tech. So I wanted to get a sense of how HCL Tech is approaching this opportunity. What's the game plan going to be like? And my question to Ram is, want to get a sense on the wage hike cycle. Obviously you mentioned, but last time you had skipped hikes for mid to senior level management. Is that something that's you are probably assessing this time as well? And wage hike cycle was, I think, last year deferred by a quarter. So what's the plan there? And also wanted to get an update on your variable pay side.
Okay. So let me address the first two questions and then Ram can address the rest. Telecom, media and publishing, I think your question was good, but unfortunately we do not share client-wise revenue, so I wouldn't be able to tell you how much revenue is from which client. But it is safe to assume we got a good benefit from the large deal, which has driven this significant growth. So this is really a unique situation where we had signed a very large deal and that's helped us grow almost 70% year on year. We do not expect this trend to continue, but overall looking at our presence in telecom segment, we see tremendous opportunities in this segment, both for cost optimization and the transformation work. And we expect to grow this vertical quite nicely moving forward as well. Coming to your question on semiconductors, yes, it's one of our big strength areas. We work with several large semiconductor firms globally. They are among our top 20 and top 50 customers with whom we've had multi-year relationships. And we had even announced being awarded the EPIC Supplier Award by Intel. So our presence in this segment is very prominent, capabilities are very strong. So that is a vertical which has definitely contributed to our technology and services segment, demonstrating both sequential and year-on-year growth.
So I'll take the questions on the wage hike and the variable. So last year it is true that when we met this time last year, we did say that we were skipping a cycle for our mid and senior management. Couple of things it's important to keep in context. One, when we say mid and senior management, it's addressing about 10% of our employee base. So 90% of our people even last year went through the regular pay review cycles as they otherwise would have gone through. So that's one. The other update is, although we made a decision back in July last year about skipping the cycle, we did in Q4 reverse that decision. Looking at our overall full year performance for FY24, we reversed that decision And we did go back and make pay increases for our mid and senior management as well. Albeit it's just 10% of our employee base, we still go back and do that. So that's a decision that we always taking into account how our performance is, and we try and make sure that there is a fair participation from all our employees in the successes that we deliver. And that principle will continue this year as well when we sit down to make our decisions this quarter. You did ask a question about, are we considering similar decisions as we did last year? That's going to be part of the decision that we'll be making when we sit down to take our decisions this quarter. I'm not in a position to say what the decision is going to be, but we will make the decision during the course of this quarter. I think the other part of your question was about variable pay. For us, the quarterly variable pay is not a very significant proportion of people's earnings. It's less than 3%. Firstly, quarterly bonus is applicable only for the employees at the junior levels, not at the mid and senior levels. And that is less than 3% of annual earnings for individuals. So it's not a significant proportion for us. And those decisions pretty much remain quarter on quarter constant. There's no significant shift in that decision this quarter.
Thank you, Ram. The next question is from Haripriya from NDTV. Haripriya, please go ahead. Haripriya, we have unmuted your line. Please go ahead.
Hello, gentlemen. CVK, I wanted to understand, could you give us your reading of the market in terms of geographies? What are you hearing from clients in Americas and Europe? And do you see these markets bouncing back strongly now? One. And you mentioned about GenAI projects. Could you tell us how many GenAI projects you're working on currently? And do you see active revenue translation happening here, given you have not called out numbers yet? Also, give us some sense on the pricing scenario. Is the market still stressed? And are you having to let go of margins for growth?
Yeah, coming to your first question, from a geography perspective, we look at Americas to be a strong geography. It is delivered very well last year. Even now, the year-on-year growth is good, and we'll continue to see good traction in the US. In Europe, it's a little bit of a mixed bag. I think we are continuing to see pressure in the industrial segment in Europe market, and we have a significant presence on that segment. So I would wait for some time before calling out that Europe is going to pick up. Your second question was on Gen AI. Last quarter we had called out, so I don't have an exact number, but roughly 200 plus proof of concepts, and several of them are getting into some SOWs and actual work for clients to scale. If you look at our investor release, we've called out some 10 key programs that we have won and we are executing. In terms of the pricing and overall environment, my assumptions remain the same as what we did in the beginning of the year. We do not expect discretionary spend to pick up, and that's not in our assumption. We think we'll have a muted discretionary spend environment, even though we are seeing here and there some sprinkling of growth drivers, but it's too early to call out if there is going to be a reversal in the trend. So we remain a little bit cautious on the discretionary spend environment at this time.
Thank you, CVK. Our next question is from Sai Ishwar from Reuters. Sai, please go ahead.
Hello.
Yes.
Hi, gentlemen. So I had two questions. One is on the mega deals. After the Verizon deal, I don't think you guys have announced any deal. So is there anything in the pipeline? That is one. And my second question is that, contribution from financial services has been constantly falling. So currently also it's around 21%, and you have, factored weakness in the coming quarter as well. So will we see, a situation where manufacturing might overtake financial services? And is there anything you would like to call out there? Because I think that will be the first time if any of the top three players would have, other than non-BFSI segment as their top vertical. Thank you.
Yeah, I mean, I obviously will not be able to tell you if manufacturing will overtake financial services or not. Of course, we want both segments to grow, and that's what our efforts are. And given the spend in financial services is still the largest, I would expect that financial services will continue to be our largest segment. And you talked about large deals. Of course, we had announced a very large deal in the previous year. Even in this quarter, we had announced a deal with the German Cooperative Bank, which is one of the largest German cooperative banks. We had announced a deal for $280 million, which is really transforming their digital foundation landscape. So I think that's a significant deal. We have called out about 7 or 8 large opportunities that we won in the last quarter in our investor release. I'll request you to look at our investor release to get a comprehensive view of the deals that we have won in the last quarter.
Thank you, CVK. Our last question for today is from Samir from the Economic Times. He's written in the chat box, do you think the growth in Q2 and Q3 will help you get to your revenue guidance? Also, could you please throw some more light on the $70 million other income from State Street? And do you see Verizon deal boost getting normalized after 2 quarters? And that's what we see in ER&D segment.
Okay. So Pratik, why don't you answer the other income and...
Sure. So Samir, as I explained, that 70 million is the portion that has been recognized as other income. And, you know, we had announced this transaction somewhere in December of last year and concluded it in April. We mentioned that as well. So there's a complex accounting going into several line items, etc. So I don't want to get into those complexities, but this is essentially arising out of that.
And then what was your first question, Sai?
Samir.
Samir, yeah.
Samir, the first question, I'll just repeat, CVK. Do you think the growth in Q2 and Q3 will help you get to your revenue guidance?
Yes, Q2, Q3 and Q4 will help us to get to our revenue guidance.
And the second question was, do you see Verizon deal boost getting normalized after 2 quarters? And that's what we see in ER&D segment.
I think these two are not linked. Verizon new deal was more managed network services, which is in our IT and business services segment. Yeah, I mean, obviously there'll be deals which will get normalized, new deals will come in. All of that has been considered in our 3 to 5% guidance for the full year. So thank you for your questions and thank you for joining us today. And that brings us to the end of this press conference, and have a wonderful evening. Thank you.
Thank you.
Thank you.
you.